Hello and welcome to Between the Lines, the podcast that brings you deep insights into the evolving reinsurance landscape from across Asia Pacific. I'm Mithun Varkey, Editor-in-Chief, and we are recording here in the Hong Kong newsroom of InsuranceAsia News. Join us as we unpack the week's biggest headlines and offer an exclusive review of our upcoming stories. Joining us for a special segment in this episode is Yann Barbarroux, founder and CEO of Otonomi, a pioneer in parametric solutions for transit delay insurance. In this conversation, we dive into the real-world mechanics of parametric cargo insurance and discuss how the current Middle East tensions are reshaping the industry's approach to risk.
With this real-time data, we can actually connect to our platform and activate the claims automatically, right? So it's really a simplified process that we offer the customers. And our KPIs in terms of payouts is right around 4 to 5 days from the triggering of the event and the time that we pay out to the customer. So that's a really game changer for most cargo owners and policyholders out there.
Joining me this episode is the InsuranceAsia News editorial team. With me is Deputy Editor Andrew Mullen, Senior Correspondent Aidan Gregory, and reporters Joana, Nguyen, and Roshan Nambiar. Welcome, everyone.
Thanks a lot, Mithun. Hi, everyone.
Great, let's get started. Last week, the big three Japanese carriers reported their year-end earnings. Pretty robust performance from the P&C carriers. Aidan, could you give us a top-down overview of the results and the factors contributing to the strong performance from Tokio Marine, MS&AD, and Sompo?
Sure, thanks, Mithun. It was indeed a strong round of annual results for Japan's big three P&C insurers. This was for the 2025 financial year to the end of March, and the top-down overview is essentially that all three have benefited from a very benign period for natural catastrophe losses in Japan, and indeed also outside of Japan, with the exception of the LA wildfires. And the underwriting performance of their overseas operations, which now make up an essential component of the overall equity story of each insurer. That's been a major growth driver for Sompo, MS&AD, and Tokio Marine, following their globalization efforts in recent years. The sector did see, the volume of profit taking from the sale of strategic equity holdings slow somewhat over the course of last year. And these share sales and the profits booked on these share sales have had a flattering impact on their earnings recently. But it was still a very strong underwriting year, primarily driven by the fact that the industry hasn't really had to deal with any major nat cat losses over the period covered.
Thanks, Aidan. Yeah, indeed, historic results for most of them, and it does seem that their internationalization efforts have really paid off, and it's the results are coming through, especially in this latest earnings. Joana, can you tell us how these three insurers performed in terms of top line, bottom line, the combined ratios, and what was their nat cat loss experience last year?
Sure. Let's get started with Sompo. So its insurance revenue increased by 6% to almost $34 billion. There was a sharp rise in earnings, with its net income going up by 163% year on year, reaching a record high of $4 billion. This is supported by improved underwriting performance, lower cat losses, and strong investment returns. Domestic combined ratio improved by 5.1 percentage points to 91%, while overseas business combined ratio improved by 7.1 percentage point to 93%. Nat cat losses in Japan fell by 39% to $353 million, while overseas nat cat losses fell over 2/3 to $203 million. Moving on to MS&AD, its non-life business net premiums written grew 7.1% year on year to over $31.4 billion. This is mainly supported by the growth of the overseas business. Its net income went up by 13.8% to $5 billion, thanks to the high premiums incomes and reduced nat cat losses. So the combined ratio of the domestic business improved to 95%, while the combined ratio of the overseas business, like MS Amlin and MS Re, both fell to around 83 and 87% respectively. Nat cat losses, like I mentioned, also fell, with domestic excluding residential earthquake decreasing by 7.2% to $159 million, with overseas losses dropping significantly by 88.5% to $51 million. And lastly, we have Tokio Marine. Its net premiums went up by 4.9% year-on-year to $55 billion. Nat cat losses of MS&AD, like I mentioned, also fell, with domestic losses excluding residential earthquake decreasing by 72% to $159 million, and overseas losses dropping by 88.5% to $51 million. And lastly, Tokio Marine, its net premiums went up by 4.9% year-on-year to $35 billion. Adjusted net income, if you exclude the capital gains from the sales of strategic equity holdings, grew by 17% to $4.5 billion in FY25. This is supported by strong underwriting growth within its overseas subsidiaries, rate increases in Japan P&C, and a significant reduction in nat cat losses. The combined ratio of the group's domestic flagship, Tokio Marine and Nichido Fire Insurance, was 95.6% in FY25. This is compared to 96.1% in FY24. Overseas businesses have slightly lower COR, ranging around 90% depending on each entity. Net incurred losses from natural catastrophe in FY went down 35% to $823 million, mainly because of the fall in losses in Japan.
Thanks for that quick recap, Joana. While the numbers look excellent overall, there was one surprise, which is Tokio Marine flagging up a reserve strengthening tied to Greensill claims. The claims stem from Greensill Capital's collapse in March 2021, which triggered about 10 lawsuits in the Australian courts. As things stand now, the companies are going through a court-sponsored mediation, which they entered in March this year. And the understanding is that at least some of those cases will be settled through a mediation process this year. So it remains to be seen what the eventual claims will be. Meanwhile, Tokio Marine in March had also announced the strategic partnership with Berkshire Hathaway. Brad Irick, the Tokio Marine CEO, told us that that the deal will strengthen its M&A capabilities and that the company has about $10 billion to spend on insurance acquisitions in the next 12 to 18 months. Interestingly, the Berkshire deal also includes a quota share agreement, but the company refuses to give any details yet on what that quota share agreement will look like. Moving on, it's been a busy couple of weeks for deal makers in the region. Andrew, can you bring us up to speed on some of the recent deals in the region?
Yeah, first up, a small bit of housekeeping. South Korea's DB Insurance is expected to complete its acquisition of Tiptree and Warburg Pincus-owned US specialty insurer Fortegra for $1.65 billion on Friday. This is according to a stock exchange filing. Tiptree shareholders had already approved the sale in December after DB had signed an agreement to acquire Fortegra in an all-cash deal in September. So that should be going through pretty soon. Now a deal that's a little bit further from completion. The Australian Competition and Consumer Commission has launched a Phase 1 initial assessment of Zurich Insurance's proposed acquisition of Beazley, following notification of the deal by the Swiss insurer on Friday. Under Australia's new mandatory merger control regime, this was introduced in January, businesses are required to notify of any proposed acquisitions that meet specific thresholds prior to the completion of a deal.
So Zurich's acquisition of Beazley is the first kind of big ticket global insurance M&A transaction to be scrutinised under Australia's new merger control regime. A part of this is technical. Given the size of the deal and Zurich's existing presence in Australia, it was always going to have to notify the ACCC about its acquisition of Beazley according to the thresholds of the regime. But there was an interesting point in the filing. The ACCC commented that there is some overlap in their specialty businesses in Australia. So we'll have to see how this Phase 1 assessment goes. We should get an answer relatively relatively quickly, likely by the end of June. It's worth mentioning also that the ACCC has blocked other insurance deals in the recent past. IAG's acquisition of the Royal Automobile Club of Western Australia's insurance business is currently in phase 2 investigation due to serious antitrust concerns. IAG actually refiled under the new regime earlier this year after the ACCC blocked the transaction under the old regime last year.
Thanks, Aidan. That puts a little bit more meat on the bones in terms of that deal. Sticking with M&A, MNRB Holdings, the Kuala Lumpur-based investment holding arm that owns Malaysian Re, has entered into a conditional share purchase agreement to acquire an 80% equity interest in Labuan Reinsurance for a total cash consideration of $100 million. Labuan Re is an associate company of Malaysian Reinsurance, MNRB's wholly owned subsidiary, which hold a 20% stake. And finally, in India, global insurance group Liberty Mutual has increased its shareholding in Liberty General Insurance in India to 74% as it seeks to develop its business and bring global capabilities more directly to the market. Having commenced operations in 2013, Liberty General Insurance is a joint venture between Summit Asia Investments, a group company of Liberty Mutual, and Enam Securities, which now owns a 26% stake. The move follows the earlier increase in Liberty Mutual's stake from 49% to 55.4% in September.
Thanks, Andrew. The Labuan Re deal was quite interesting. The Malaysian reinsurer was being shopped around for a few years. However, there wasn't a lot of takers. The MNRB deal, which owns Malaysian Re, obviously, is quite an interesting deal. It's a classic soft market play using a more benign pricing environment to simplify structures and sharpen capital deployment and position for the next turn in the cycle. So that's quite an interesting deal. And the Indian deal, obviously, we've been seeing foreign companies increasing their stakes in their Indian joint ventures since India relaxed the foreign direct investment limits for insurers. Looking ahead, the latest typhoon season outlook from Munich Re presents a grim forecast. Roshan, you were writing the story. Tell us what exactly are we up against as we head into these next few months?
Yeah, so we are starting to see early signals that typhoon risk could rise quite sharply this year across Greater China, South Korea, and Japan. Well, according to the Munich Re outlook, developing El Nino conditions, with the possibility that this could evolve into a so-called super El Nino, could shift storm tracks further to the northeast while also supporting more intense systems. In terms of activity, the Northwest Pacific Basin is expected to run above the long-term average, which current projections show that there will be around 27 named storms, including roughly 18 typhoons and 11 severe typhoons. What is particularly relevant from a risk perspective is that the role of warmer sea surface temperatures combined with the El Nino dynamics could allow storms more time and energy to intensify before landfall, which raises the potential for higher loss severity, especially in densely populated and coastal regions. There's also a longer-term signal worth noting, which is that scientists are continuing to observe a gradual poleward shift in typhoon tracks, and if this persists, it could incrementally increase exposure for markets such as Japan and areas around the South China Sea.
Thanks, Roshan. Yeah, it's indeed worrying. It's been a couple of years of benign typhoon activity in Japan, certainly. This is probably the year that we have to brace for a return of some of those big typhoons. While talking about windstorms, there's some recent interesting data from the Australian Research Pool Corporation, which runs the Cyclone Reinsurance Pool. Roshan, can you tell us what the impact of the Cyclone Pool on insurance pricing and availability in Australia has been?
Yeah, so the Australian Reinsurance Pool Corporation indicated that since the scheme launched in October 2022, home insurance premiums in the most cyclone-exposed regions have fallen by around 37%. And at the same time, insurance availability has increased by 27% as more insurers participate in the pool. In terms of scale, the scheme now covers over 3.2 million properties and has already paid out more than 1.4 billion Australian dollars in claims. As we can see, the Cyclone Reinsurance Pool is beginning to show tangible impacts on both affordability and market access in Australia.
Great. That was a fantastic discussion. What's on the radar for this week? Joana?
So I'll soon be having an interview with Philip McDowell, Global Sales and Distribution Lead for International Programs and Captives at HDI Global. In the interview, he will share with me the key trends shaping international programs today, as well as why international programs are becoming, more critical for multinational clients. Amid the heightened geopolitical tensions and a fragmented regulatory landscape. So I think this will be an interesting conversation.
Thanks, Joana. Look forward to that story. Aidan, what's keeping you busy?
So speaking of merger control in Australia, I'm actually working on a sort of deeper dive into this topic. And, we're nearly 6 months now into the life of the new merger control regime in Australia. And I'm looking at sort of how the regulation has impacted the M&A insurance market. When you speak to local brokers and underwriters, they're saying that this regime, which is tough, like it's massively increased the powers of the ACCC to block takeovers earlier in the process, and it's brought Australia into regulatory alignment with other jurisdictions with very powerful competition regulators like the European Commission and the SEC in the US. So this has introduced, quite a lot more execution risk and complexity in Australian M&A processes, particularly for large cross-border deals. And people think that's going to, spur more interest in innovative risk transfer solutions.
Great. Thanks, Aidan. On my end, I've got quite an interesting meeting lined up for next week. I'm talking to Su-Cheng Chung, the CEO of Mark Hill Asia Pacific, as well as Andrew Mullen, who is president of Mark Hill International. I think this is the first interview Su-Cheng is giving since he's taken charge last year as the regional head. It'll be an interesting conversation about Mark Hill and its plans for the region. Thanks, team. Another great episode in the books. Now let's get back to work. In this episode, we are joined by Yann Barbarroux, founder and CEO of Otonomi, a specialist in parametric transit delay insurance. Yann is leading a path-breaking charge by taking index-based products, which we typically see in NatCat insurance, and applying them to the world of cargo insurance. He provides deep insights into the evolution of parametric cargo cover and the critical variables driving the product and the factors influencing claims. We also tackle a very timely topic, how geopolitical volatility, particularly the Middle East conflict, is influencing the strategic future of cargo insurance. You don't want to miss this one. Yann, thank you very much for agreeing to join our podcast. Welcome.
Yeah, thank you very much for having me. That's a pleasure joining you.
So, to start off, could you tell us a little bit about yourself and about how you came about starting Otonomi?
Yeah, absolutely. So my name is Yann. I'm CEO and founder of Otonomi, Otonomi.ai. I founded the company in 2021. Originally in New York City in US. So a little bit about myself. I spent most of my adult life, my career in the United States, New York cities, mostly, largely in commodities trading, risk management, and also fintech and insurtech, technology innovation, really trying to bridge the gap in terms of bringing a new solution to the industry. And it seems like obviously global trade, supply chain, logistics have been really outdated in many ways in terms of the kind of software technology and the insurance side of it. Marine cargo transportation is also one of the most legacy sectors within the space. So right around COVID, I decided to quit my 9-to-5, take the leap of faith, and really bring the best of financial derivatives, risk management, and technology innovations in order to disrupt marine cargo transportation and supply chain. That's kind of the genesis of what I'm doing, and why I'm doing it.
Great. Otonomi sort of brings parametric insurance to logistics, really, right? Parametrics is a fairly new idea for most of the world, but even for the insurance industry, parametrics were primarily implemented for weather risks. It continues to be still the biggest part of parametric insurance's application. If you brought in transit time delay insurance. That's, as I understand it, that's the primary product for Otonomi. Can you tell us why did you choose parametric insurance for your product and how that sort of works in the real world?
Yeah, so the storyline is the following, right? So as I kind of alluded to it, a lot of why I started to get very intrigued about this specific use case was the global trade interruption during COVID. So all air traffic, vessel, maritime transit was either completely canceled or disrupted, which created dozens and billions of dollars of business interruption risks and also direct consequential damage to the industry. And investigating the sector, it turned out that marine insurance, which is one of the oldest and legacy insurance policies in the world, as kind of an anecdotal story, the first marine insurance was written in a coffee shop in London back in the 1600s, which turned out to become, the Lloyd's market after that. So those legacy contracts never managed to actually adjudicate properly disruptions, cargo delays, and maritime congestions properly. So therefore, that's really a gap that I'm really overtake in order to, bridge the insurance coverage globally, really with the intent to bring something new, something fresh, something functional for the cargo owners, the shippers, the freight forwarders in space. And not only are we bridging that gap, but we really going the route of simplifying the insurance experience. So a parametric structure was the best candidate for it, right? So as you mentioned, parametric insurance, so index insurance, as they've been called sometime, of generally focused on nat cats, natural disaster, weather events. So we ported this concept into global transportation. And the really bridging the gap of cargo delays and disruptions in maritime and aviation was one of the biggest use case that we wanted to address. We currently assess this gap as being nearly $68 billion of losses that are uninsured every year. And really trying to democratize this insurance using technology, data, and really fast claims payments, which is really the rules of the game here, because a parametric product can be good on paper. If it doesn't pay out, obviously it's useless for the customer. And the past couple of years, we've been proving to the market this is exactly how we execute and we deliver. So that's been incredibly exciting, very hard in many ways, but I'm very glad to be running that journey.
Sure. I mean, so it's index insurance. You need a reliable index to sort of price to rely on to make the payouts for a parametric insurance. Well, how do you sort of design the index, and what do you rely on that triggers the payout? So how does that sort of design of the index work?
The general concept behind parametric insurance, as we laid out, is having an independent source of data in order to trigger the mechanics, right, of the policy based on thresholds or quantitative triggers. And so typically, outside of what we do, but let's say in the nat cat space, if you get an earthquake severity 8, on the Richter scale, that would be the triggering event upon which there would be a fixed payment going to the counterpart, the policy holder. So this concept is also true for what we do. Although the index in our case is not really like a named peril, it's not an external event, but this is the pure maritime transit delay or air cargo transit delay that we're using. So in order to make it very independent, non-disputable, we embarked into a pretty, heavy lifting type of technology integration work with global visibility platforms, API providers, vendors that essentially provide what we call track and trace for cargo, which has been developing, I want to say, the past 10 years in a very meaningful way, and that's been bringing to the logistics, the shipping space, a tremendous amount of value. So we've thought that the timing for developing an insurance product based on the improved visibility within maritime and aviation was actually pretty ripe, right? So we were very excited about saying, now that the track and trace market has been more effective, now is the time to leverage the data, the visibility and transparency in order to actually trigger those parametric products in a very efficient way. So we have a flurry of partners and vendors globally that we rely on in terms of pulling the right data for containerized market, bulk shipping, air freight, time critical parcels. And with this real-time data, we can essentially connect to our platform and activate the claims automatically, right? So it's really a simplified process that we offer the customers. And our KPIs in terms of payouts is right around 4 to 5 days from the triggering of the event and the time that we pay out to the customer. So that's a really game changer for most cargo owners and policyholders out there.
So you rely on track and trace intelligent service providers on their data to determine the trigger.
Correct.
And how does the product sort of sit in the world of cargo insurance? I mean, is this a complementary sort of an insurance product that people buy, and who are the primary customers?
Yeah, absolutely. So it's a little bit of the hidden secret, which it's not that hidden because everybody's aware that delays are actually formally excluded from 99% of marine policies globally. So the way we position the product more often than not is like an insurance buyback. It's supplemental, it's complementary, it's a rider, on top of the cargo insurance. This is where we find a lot of interest, right? Our distribution is largely with large international brokers, insurance brokers, or it can be regional, mid-market brokers, also with certain specialty in terms of the kind of sectors that they service. We can find a variety of interest globally, but more often than not, there's like low-hanging fruit industries that are going to be prone to a lot of those financial risks due to delays. So no pun intended, but perishable export is one of those low-hanging fruit. Pharmaceuticals, life sciences. There's also like other time critical sectors such as automotive, where the typical line shutdown of the assembly manufacturing line that can be essentially stuck and create operation losses in the tune of $250,000 per hour of delay. The aerospace, the aviation, so any critical parts that needs to be at a certain location, certain time. Let's say if an Airbus needs a replacement nose landing gear that they order from Safran, and the critical part doesn't make it, let's say Monday at 9 a.m. Again, every hour of non-operations could be costing hundreds of thousands, millions of dollars. And these are not physical loss or physical damage that we insure. It's really the financial liabilities arising from delays. So, in terms of distribution, positioning is whatever I described in the insurance space. It turned out that, it's very popular in the freight forwarding space. So the logistics, 3PLs, those companies are actually very well attuned with cargo insurance. So sometimes they call it shipper's interest. They actually really like, having this value-added service within their toolkit because, it gives them a way to actually differentiate. It's also increase revenue. And our delay insurance has become the kind of the new shiny object for freight forwarders to actually monetize with their customers because delays have been plenty, unfortunately these days. And, we are the only solution out there, right? We have no competitors to date.
Cool. I mean, you said you started in New York. Do you write business from around the region? I know you write from Asia Pacific. Can you give us a sort of where you write from, where you write business from, where you see most opportunities in as markets go?
Yeah. So I started the company in North America, where I was located at the time. I since then moved to Singapore. So I'm based in Singapore since January. The development of the company has been naturally kind of regional expansions around Americas. So first North America, then rapidly we get a lot of interest from South American clients, perishable exports of fruits, flowers, meat, seafood has been one of the revenue generator for us for some time. And then we opened an office last year in Paris for our European platform. And then I decided that Asia Pac needed some specific focus. And I thought Singapore was, one of the logistical hubs of the world where really you find, a lot of decision makers in terms of large corporates, insurance, finance, and freight forwarding. And we since then, opened an office in Singapore as well. So we have 4 locations. US, South America, actually 5, Paris, Hong Kong, and also Singapore. And so we trade globally. The reason why we expanded fast in terms of geography is largely because global trade is international, right? You want to be essentially servicing customers on both sides of the world. A lot of the customers are international. They have international operations. They want to essentially use our programs for any of the locations they can. And then for risk management purpose, you want to be diversified, right? Because, if we had started, let's say, kind of a big program in the Middle East now, I mean, a few years ago, now we would be completely shut down. We would be bankrupt. The reason why we are, really having people in different locations is because sometimes you're going to have some disruptions in Asia and the North American books could be performing. And sometimes, Brazil is going to be a problem. And then the European accounts are going to be managing, the account well. So the diversification of our risk management strategy is really dependent of, how commercially we're going to market with.
The value of a transit delay insurance is probably most exacerbated by the recent Middle East conflict, where we've seen, with the blocking of the Strait of Hormuz, holding back shippers of all kinds, right? What's been the impact of the conflict on your business? Are you seeing more take up? Have you had any claims pay out as a result of this conflict in the Middle East?
Yes. Before I get into the detail, I wanted to also maybe rehash a little bit of the kind of the BAU business as usual risk that we cover, right? Not necessarily those black swan events, although they also cover it in many extent. But, our customer come to us when they suffer, kind of those risks that may happen, once a month, every couple of weeks, sometimes can be more often, more frequent. And that goes along, shipments that's not loaded on the right vessel, called roll shipment or bump shipments. That can be transshipment risks when, some containers are being moved from a vessel to another one, take delays at, kind of the stopover between different ports. Same with airports when it comes to aviation risks, ground handling issues, weather events, right? So we're going to get into the typhoon season in the next few months in Asia. There's going to be a similar season of hurricane in the Gulf of Mexico in US and in South America. There can be a variety of other issues due to weather and nat cat risks, which are external, but they result into a delay. So therefore they can trigger our policies. And, anything under the sun, right? So demurrage risk, that's very high kind of profile type of liabilities. And also congestions, right? So the general congestions that can be happening at any point of time. But going back to your questions, obviously since March 1st, we've been seeing increased volatility, right? So we've seen volatility increase in the tune of 20 to 25% on average for the global markets, and let alone like the region around the Middle East that's been, obviously like completely disrupted. So the way, we experienced this very unusual, which now, fortunately has become much more usual than it used to. Like those black swan events happen like several times a year, none once every 10 years. But we have paid claims, so this is kind of number one. This is the good news. We didn't lose our shirts overnight because our claims have been, kind of a limited size for the most part. We have claims, ranging from $10,000, $25,000, $50,000 per policy. So this is still fairly manageable. To be quite frank, on my end of the spectrum, because this is a new product, I view it as, kind of net positive that we pay claims, because it gives a chance to customers getting benefits of this automation, the transparency. Obviously, loss ratio picked up a little bit, but we've been staying within the range that we are targeting for the most part. So I'm glad that, we made, a few happy customers along the way. The other thing that's also true, we have very fast and nimble risk management measures that's, essentially we're developing, early March as the situation was worsening. So, from, all the policy that were written and really like bound before the conflict, those policy were covered, right? So we did pay claims on the back of it, although it was, a small number of them. Any type of clients coming to us for new policies beyond March 1st, since the ports in the Gulf were closed, Hormuz, Jebel Ali, and so forth, we stopped underwriting new policies at that point. Mm-hmm. So de facto, we didn't have new claims, but not because we excluded, it's because we didn't underwrite to start with. Where we actually had some level of benefit for the customers is any type of deviation or rerouting on the back of this conflict. We had a few cases of, initial transit route to Jebel Ali get rerouted to India, for instance. As long as the parameters were still, outside of the trigger event. So, it can be 6 days, 8 days, 10 days, and so forth. And then it was recognized by the technology, then we would pay out with no question asked, right? So there was several factors where actually the customers benefited from our products, where on the flip side, as you probably heard, there was a flood of cancellation notice from traditional underwriters. Marine underwriters, stopped paying claims, stopped paying or underwriting and covering our customers within 7 days, right? So which was not our positioning. We continue supporting our customers as much as we could.
So you don't have the typical 7-day cancellation clause that's pretty standard for the marine market. You don't operate on those terms. You're more, you'd written policies and you just paid out because there was a delay. That's how it works.
Yeah. So it was more pinpointed, because we did stop underwriting certain ports as well on the back of the conflict, but it's not like we stopped the program completely.
The conflict's been prolonged, so you continue to not write business from there, but you'll still write business that has sort of knock-on effects like deviations. Is that correct?
Yeah, correct. So, a few more details about, what happened, during March and April. So what we saw is shutdown of the Gulf. We also experienced shutdown of Port of Dubai. So DXB, Doha, which were shut down for about 5 to 7 days. We reopened underwriting, very quickly after for aviation risks. So the interruption was very, very concentrated in a few days. We did have, obviously, any type of deviation or routes that were around the region that was never excluded. So we continue covering existing policies or writing new policies. And as you pointed out, we also covered some of the trade route that were essentially discharging in the Gulf that were rerouted, and if they were causing delays, we were paying claims on that perspective.
Just trying to understand you mentioned your business as usual claims from nat cats and other sort of. What are the major trends you're seeing in terms of risks for your product? I mean, is it nat cat? Is it port congestions? We've had other issues like there's for example, the Panama Canal had a drought in the Panama Canal, and there's lots of different factors that are affecting transit times. What are the major trends you're seeing from your own claims perspective?
Yeah, exactly. So, to be completely transparent, war and those black swan events, God forbid, they don't happen as often, and this is not the major, the lion's share of what we're paying claims. What we pay claims are actually a little more mundane issues, which are equally damaging in many ways for customers. That would be obviously logistical disruptions on the ground, right? Or, longshoremen, stevedore, port operators, making some mistakes, or essentially having, some vessels stranded for 5-7 days for reasons that are completely, opaque to some of the customers. And when you move, pharmaceuticals, perishables, or time-critical goods, it turned out that, even 5 to 7 days can be completely disastrous for your business, right? And those events, usually they're very hard to, adjudicate, right? So you go to the carriers, you go to the vessel owners, you go to your traditional insurers, and you explain that you might have lost, $200,000 on the back of a logistical event that did not essentially result into a physical damage necessarily, but creating a lot of financial liabilities. We can talk about business interruptions, loss of revenue, loss of market, consequential damages, and so forth. And usually get denied with our product because it's a little bit of immune to any type of reasons or root cause. Because you suffer a delay, then the mechanisms could be essentially activating your claims. You're going to get your money within 5 days, give or take, and then you can move on. Because as you can probably guess, when you get out of the large tier one enterprise, sector where, those companies have very robust balance sheet, you actually start servicing a lot of the SME mid-market players with a very thin or fragile balance sheet, and the cash flow, management is one of their concerns. And we have actually helping them operate, because the claim is coming faster, so they can actually re-inject the cash in terms of any new transportation costs or mitigate their reputational risk with their end customers. The list is long, but we're really trying to be customer-centric, understanding the nitty-gritty of the logistical risk events that they're suffering, and making the process as fast as possible so they can mitigate those risks in a quick manner.
Great. Before I let you go, if I can ask, how big is Otonomi in terms of, would you be able to share numbers on your premiums you write, or how big you are in terms of your top line?
Yeah, absolutely. So we now a team of 20 people, right? We grew quite a bit the past 6 to 9 months. Really excited about the global expansion. We continue hiring in Asia, so I'm glad to receive a resume CV from candidates. We passed the $1 million mark of GWP, so $1 million in December, and looking at an expansion of $4 to $5 million in the next 12 months for the next chapter of our growth. It's really linked to the fact that we started with SME mid-market, operating on really kind of the one-off basis, really trying to grow our portfolio one client at a time. And since then, we attracted interest from international enterprise players in the tier one brokerage space, tier one freight forwarding space, and also shipping lines themselves. So we started to see the scalability of the product, really going 3 to 5x in the next 12 months.
Great. Wish you all the best with your growth plans, and I hope you grow as fast as you plan to. Thank you very much, Yann. It's been a wonderful conversation.
Thanks for having me. That was a pleasure reconnecting, and looking forward to meeting in person again.
That's all from us in this episode of Between the Lines. We'll be back again in 2 weeks. In the meantime, you can connect with us on LinkedIn. Make sure you're subscribed to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.